Well, is the economy on track for a soft landing? That's a big question. U.S. Treasury Secretary Janet Yellen seems to think so. She said at the Wall Street Journal CEO Council Summit that the economy is currently on path with inflation falling. She added that the job market remains strong and there isn't, quote, any good reason to think that the last mile is going to be especially difficult. But our next guest does not agree. Let's bring in Cindy Beaulieu, who is the conning CIO of North America. Great to have you here with us this morning. First and foremost, soft landing, your own projection, and are you more in the camp of Treasury Secretary Yellen, or is there something else that you believe is brewing?
That's a great question, Brad. Thank you. It's great to be here. So as we talk about soft landing, we have not been a buyer of that possibility really since the beginning. We didn't see how the Fed was going to navigate that when you think about how dislocated the economy was as a result of COVID. And to actually bring us into a soft landing through all of that would be really quite miraculous and didn't seem to be in the cards. We felt a little bit more confident about that idea as we've moved through the back half of this year, and we've seen the way the economy is reacting to some of what the Fed has done to this point, or all of what the Fed has done to this point, but the full reaction hasn't really been felt yet. We've seen the rolling recession, and we do believe in it, and so housing had it, manufacturing has had it, and now we're heading for the consumer. And we think that the consumer does really pull back in these next several months. That puts us at the point of a mild, modest recession in the late first quarter into the second quarter of next year. And that is why we don't see the possibility for a soft landing. The consumer has been incredibly resilient, but we're starting to see enough cracks to suggest that maybe the consumer is finally wearing down.
So, Cindy, if investors do agree with you, they're trying to figure out how to best position their portfolio, maybe prepare their portfolio for a recession. What are some of the adjustments that investors should be making right now?
Sure, that's a great question, Shauna. So, as we look at where markets sit today, we think that they are way ahead of where they should be. Rates have come down dramatically since the November Fed meeting, and that's really been on the back of economic data that market participants feel is lining up to enough softness that the Fed can actually pivot, and maybe even pivot at the end of the first quarter or early second quarter of next year. We don't see that. So we would suggest that you certainly can be in bonds, and that buying some duration in bonds makes some sense, but maybe be a little bit patient with it, because if we're right about how we expect Jay Powell to take the podium today, then we don't think the current level of a 10-year Treasury is appropriate, and we may see a little bit of a rate sell-off here if he's hawkish enough. So we think that there's room for bonds in portfolios for sure. We like less cyclical names, certainly as we try to work our way through this last part of the recession. And we like, generally speaking, though, investment-grade corporates, high-quality corporates. We also like a lot of the structured parts of the market. And I think that that's an area where it's been a little bit left behind through all of this, because people have feared if we get a significant recession, they think back to the great financial crisis, and they don't want to own mortgages. The mortgages we see today are not the mortgages of 2008. And so there's certainly room to have a mortgage allocation in portfolios, and we think it can be a quite attractive income stream.
Cindy, you mentioned what the markets are going to be listening for when Fed Chair Jay Powell takes the podium later on today. Jack Manley from JP Morgan earlier in the show gave us the kind of sobering cold water reminder that it's not the Fed's responsibility to tell markets what the markets want to hear. They have their own dual mandate, and they move forward with that eye on inflation and full employment. All that considered, what will you be listening for that can ultimately kind of signal one way or another that we could potentially get the rate cuts next year that the market is looking for, hoping for, and kind of banking some of their own portfolio strategies around?
Sure. I mean, we're basically looking at three key factors today at 2 o'clock. One is going to be the positioning of the dot plots. That's going to be incredibly critical to determine just how much of the rate cuts that market participants have built in, 125 to 150 basis points. Does the Fed really believe that they can execute anything close to that? And we think the market will be disappointed. The next thing we'll be looking at is the SEPs. The Fed backed out the recession call in June with the SEPs and maintained a pretty resilient looking economy with the September SEPs. So come December, in this next round, are they going to show, what level of economic growth do they expect in 2024? And is it going to signal that that soft landing maybe isn't a possibility? But also importantly, inflation. Right now, their core PCE target for 2024 is 2.6%. That's not 2%. And this market has been incredibly euphoric about the idea that we're going to have this immaculate disinflation just continue unchecked. And we don't see that. There are sticky elements of inflation that are going to make this more difficult for the Fed to continue for the Fed to bring rates down anytime soon. So we think between what you're seeing in shelter inflation and what you're seeing in services inflation, the Fed has to hold the course for longer. 25 or 50 basis points of rate cuts near the end of next year, that's certainly reasonable. But to stay out of the election cycle while inflation stays above their goal of 2%, we think that that's a reasonable way to think about things. And the last thing is this hawkish tone. We expect him to come out of the gates as hawkish as he possibly can be. And I think one of the things he could use to maybe get markets to understand what the Fed is thinking is to talk about the fact that maybe the neutral rate isn't what everybody thinks it is today. And maybe it does, in fact, have to be a little bit higher. And if they start to talk about that, that then starts to set the bar for where rates have to go from here. And I think that's how you get the disappointment and you see all parts of the curve shift higher.
Well, Cindy, what are your thoughts just on the neutral rate and where you think maybe it should be at this point?
So we do think it should be higher. We think that the Fed is going to have a very difficult time getting back to 2% for really quite some distance in the future. As we think about the things that have happened to the global economy over time, there are things that are just different now. Deglobalization is definitely a factor. The way we are spending money in this country on the fiscal side is also a factor. And when you think about the shift towards greener and cleaner energies, those are expensive and those are inflationary. So we don't expect that fiscal spend to go the other way anytime soon. And the other part of it is our aging population in this country. It's really a challenge. And so we have more and more people that are reliant on the government for support. That means more spending. So we see a path for inflation to maybe get back to about 2.5%, but it's really going to be tough to bring it back to 2%. And we also believe that at some point, the next that is, how do they start to think about moving that target a little bit higher as well?
Cindy Beaulieu, always great to get your perspective. Thanks so much for joining us here this morning. Conning, a CIO of North America. Thanks.
Great. Thank you.